Singapore, one of the richest countries in the world, yet it has the third highest debt globally. That might sound like a red flag, right? After all, when we think of countries drowning in debt, Greece, Italy, the US, or even Japan come to mind. Their economies struggle under the weight of massive loans, forcing them to cut budgets and raise taxes. But Singapore, it doesn't just survive with its debt, it thrives. Unlike the US or China, which borrow to cover budget deficits or boost short-term growth, Singapore has found a way to turn debt into wealth, an economic cheat code that other countries can't seem to replicate. But how does this work? And why don't Germany, Sweden, or Hungary follow the same strategy? Let's break it down. How most countries handle debt and why it fails. Most nations borrow for three main reasons. 1. Spending beyond their means. Many countries like the US and Italy spend more than they earn, running on budget deficits. To cover the gap, they borrow year after year, leading to unsustainable debt growth. As debt piles up, governments spend more on interest payments, leaving less for infrastructure, healthcare, and education. To manage debt, they often cut public services, reducing healthcare, pensions, and education funding, raise taxes, increasing tax burdens to generate revenue, borrow more, taking new loans to cover old ones, worsening the debt cycle. Real-world examples. With $34 trillion in debt, the U.S. keeps borrowing to fund military spending, social programs, and public services, raising concerns over long-term financial stability. Italy, one of Europe's highest debt-to-GDP ratios, forcing large portions of its budget into debt repayments, limiting economic growth. The consequences of overspending. Financial crises, unmanageable debt can lead to economic collapses, e.g. Greece's 2010 crisis. Recessions. High debt limits government spending, slowing economic growth. Lower investor confidence. Foreign investors hesitate to lend money to debt-heavy nations. Overspending weakens economies, making recovery harder after financial debt to fuel growth, but at a cost. Some nations take on massive debt not just to cover expenses, but to accelerate economic growth. Instead of borrowing for social programs or deficit spending, countries like China use debt to fund large-scale infrastructure projects, real estate development, and industrial expansion. At first, this approach seems effective. It creates jobs, improves infrastructure, and boosts economic output. Roads, railways, and skyscrapers rise, fueling rapid development. However, the problem arises when borrowed money stops generating high returns. When projects become overbuilt, inefficient, or unprofitable, the economy slows down, leaving the country with mounting debt and fewer ways to repay it. If debt levels grow too high without sufficient economic growth, a nation can face financial instability or a debt crisis. China borrowed heavily to fund rapid urbanization, constructing entire cities, highways, and industrial zones. However, aggressive expansion led to an oversupply in the real estate market, with many buildings remaining empty. Slowing economic growth and rising debt levels now challenge China's ability to sustain its economy. Japan followed a similar strategy in the 1990s, using heavy borrowing to fuel expansion. After a financial bubble burst, the country entered a prolonged period of stagnation while carrying a high debt-to-GDP ratio. Despite decades of government spending and low interest rates, Japan has struggled to revive growth. Using debt for expansion can work if managed carefully, but it becomes dangerous when economic growth slows, projects fail to generate returns, or debt spirals out of control. A nation can fall into a debt trap where borrowing more money just to repay old debts leads to long-term financial instability. While debt-driven growth can create rapid expansion, poor management can result in financial crises and status 3, borrowing to cover short-term crises. Even well-managed economies resort to borrowing during economic downturns, wars, or global emergencies. In times of crisis, governments issue bonds, take out loans, or print money to fund stimulus programs, provide social support, and stabilize their economies. While this offers temporary relief, excessive reliance on debt during crises often leads to long-term financial instability. Borrowed money helps prevent economic collapse in the short term, but once the crisis ends, countries must still figure out how to repay it. During the COVID-19 pandemic, Many European nations took on massive debt to fund stimulus packages, business relief programs, and healthcare expansions. While this prevented immediate economic disaster, it also added to already high debt levels, putting future financial stability at risk. Greece faced severe economic turmoil after the 2008 global financial crisis and was forced to borrow heavily to stay afloat. As debt spiraled out of control, Greece required multiple bailouts from the European Union and the International Monetary Fund. This led to a decade of austerity measures, budget cuts, and economic hardship. Borrowing during crises can stabilize economies in the short term, but it comes with serious long-term risks. Once the crisis ends, countries still have to repay what they borrowed, which can strain national budgets. If economic recovery is slow, high debt burdens can reduce investor confidence and stall growth. To manage repayment, governments may be forced to raise taxes or cut essential public services, leading to political and economic instability. While borrowing for short-term crises may be necessary, excessive debt can trap nations in cycles of austerity and financial struggles, making long-term economic stability harder to achieve. Why Singapore's debt strategy is different. Unlike most countries that fall into debt traps, Singapore has mastered the art of using debt as a tool for long-term wealth creation. Instead of borrowing to cover budget deficits, fund unsustainable growth, or manage crises, Singapore strategically invests its borrowed money into global markets, tech companies, real estate, and sovereign wealth funds, generating high returns that strengthen its economy. This disciplined approach allows Singapore to maintain financial stability, even with one of the highest debt-to-GDP ratios in the world. Singapore doesn't borrow to cover spending gaps. Instead, it channels funds into high-yield investments that grow national wealth. Unlike many nations that rely on deficit spending, Singapore operates with balanced budgets, ensuring debt is used strategically rather than out of necessity. Sovereign wealth funds, like GIC and Temasek Holdings, manage and grow the nation's assets by investing in global markets, infrastructure, and high-growth industries. If Singapore's debt strategy is so effective, why haven't other nations copied it? That's what we'll explore next. Singapore's debt strategy, the infinite money loop. While most countries borrow to cover financial shortfalls, Singapore does the opposite. The government actually runs a budget surplus, meaning it collects more money than it spends. So why does it still have such high debt? The secret lies in Singapore's debt as investment strategy. Instead of borrowing to fund government expenses, Singapore uses debt to generate wealth. A key part of this strategy is the mandatory pension fund system. Unlike other countries that rely on foreign lenders, Singapore's government borrows from its own citizens through the Central Provident Fund, CPF. Citizens contribute a portion of their income to this fund for retirement savings, and the government reinvests it into global markets, turning debt into a profitable financial tool. Singapore channels its borrowed funds into two powerful sovereign wealth funds, Temasek Holdings and GIC, Government of Singapore Investment Corporation. These funds strategically invest in stocks, real estate, and tech startups worldwide, generating massive returns that strengthen the nation's financial position. Instead of accumulating debt as a burden, Singapore uses it as capital to grow wealth, making its economy one of the most resilient and financially secure in the world. This creates a self-sustaining cycle where borrowed money isn't just spent, it works to generate even more wealth. The profits from these investments are then used to repay the pension fund, ensuring financial security for retirees. They also fund public services like healthcare, education, and infrastructure without relying on high taxes. Additionally, this strategy strengthens the economy, keeping Singapore financially stable and globally competitive. Instead of debt being a burden, Singapore turns borrowing into a tool for wealth creation, a strategy that most nations struggle to replicate. Why don't other countries copy Singapore? This strategy sounds foolproof, so why don't the US, Germany, or Sweden follow suit? The answer? It's not that simple. Budget discipline matters. Most nations, including the US and Italy, already struggle with budget deficits. Their governments consistently spend more than they earn, relying on borrowing just to cover basic expenses. If they borrowed even more to invest, they'd risk economic collapse. Without a surplus-driven financial system like Singapore's, they lack the foundation to turn debt into a profitable tool. Political pressures play a major role. Countries like Hungary and France face intense public demands for increased spending on welfare, tax cuts, or military funding. Any extra money they borrow would likely be spent immediately to satisfy short-term needs rather than invested strategically for long-term growth. Governments in democratic nations often prioritize policies that win elections rather than those that ensure long-term financial stability. Lack of public trust is another major barrier. In Singapore, citizens have confidence that the government will manage their money responsibly, but this level of trust is rare elsewhere. If the US or Germany announced they were using pension funds for large-scale investments, the public would likely react with skepticism and outrage. Many people would fear government mismanagement, corruption, or economic downturns wiping out their retirement savings, making such a strategy politically and socially unfeasible. Singapore's unique position as a global financial hub gives it a significant advantage. Its political stability, business-friendly environment, and strong regulatory framework make it an attractive destination for investors. Larger economies, however, face greater political and economic complexities, making it difficult to replicate this model. Countries like the US, Germany, or France must navigate diverse political interests, economic fluctuations, and social demands, which can prevent them from adopting Singapore's disciplined investment approach. Global market crashes pose a significant risk. If a major financial crisis were to occur, investment returns could plummet, putting pressure on Singapore's ability to sustain its debt strategy. Since much of the country's financial stability depends on the performance of global markets, a severe downturn could lead to lower returns from its sovereign wealth funds, affecting public services and economic growth. Singapore's dependence on foreign markets is another potential weakness. Since much of its wealth is tied to investments in global economies like the US and China, any major economic downturns in these countries could impact Singapore's financial position. A slowdown in these key markets could reduce returns on investments, affecting the country's ability to maintain its self-sustaining cycle. Policy changes also pose a risk. Future governments may not manage investments as effectively or could shift economic priorities, leading to potential instability. A mismanaged investment strategy or policy shift could weaken the financial foundation that Singapore has carefully built over the years. Despite these risks, Singapore remains one of the few countries with a AAA credit rating, proving its financial stability and disciplined approach to managing debt. While countries like the US, Germany, Sweden, and Hungary grapple with economic uncertainty, Singapore stands out as an exception. Its ability to turn debt into wealth is a testament to disciplined governance, strategic investments, and long-term planning. Could other nations follow Singapore's example? Theoretically, yes. But in reality, political instability, budget deficits, and lack of trust make it nearly impossible. What do you think? Should more countries attempt Singapore's strategy? Let us know in the comments. Like, subscribe, and hit the notification bell for more insights into global finance and economic trends.